Global economic crisis, a comparative historical analysis. Global economic crises have occurred throughout history, shaping the way nations and the world at large view financial stability, markets, and government intervention. Each crisis is unique, yet they share common causes and repercussions. By examining the most significant economic crises in history, we can gain insights into the underlying dynamics that lead to financial disasters, as well as how societies have responded and recovered. This comparative historical analysis will focus on four major global economic crises: the Great Depression of the 1930s, the 1973 oil crisis, the Asian financial crisis of 1997, and the global financial crisis, GFC, of 2008. Through this lens, we'll explore their causes, impacts, and lessons learned. 1. The Great Depression, 1929 to 1939. The Great Depression remains one of the most severe global economic downturns in history. Triggered by the 1929 stock market crash in the United States, it rapidly spread to economies worldwide, deepening the economic crisis. The primary causes of the Great Depression were excessive stock speculation, a lack of regulatory oversight in the financial sector, and unequal wealth distribution, which contributed to an unsustainable boom in the 1920s. The immediate effect of the Depression was a catastrophic contraction in economic activity. Global GDP fell drastically, industrial production plummeted, and unemployment rates skyrocketed. In the US, for example, unemployment reached about 25% and poverty was widespread. Additionally, trade barriers, such as the Smoot-Hawley Tariff Act in the US, worsened the global economic situation by stifling international trade. Countries around the world reacted differently to the Depression. In the US, President Franklin D. Roosevelt implemented the New Deal, a series of programs aimed at relief, recovery, and reform. These policies focused on banking reforms, public works programs, and social safety nets. Many European countries, meanwhile, adopted protectionist policies to safeguard their own industries, though these were less successful in alleviating the economic malaise. The Great Depression reshaped global economic thinking, laying the foundation for Keynesian economics. Economists such as John Maynard Keynes argued for government intervention to stabilize economies during downturns. The global response to the Depression set the stage for the Bretton Woods system after World War II, which introduced a new framework for international monetary cooperation. 2. The 1973 oil crisis. In 1973, the world faced another severe economic shock, this time driven by the Organization of Petroleum Exporting Countries, OPEC, which decided to impose an oil embargo. The reasons behind the embargo were geopolitical, tied to the Yom Kippur War between Israel and its Arab neighbors. The OPEC nations, angered by Western support for Israel, reduced oil production and raised prices dramatically, causing a global supply shortage. The immediate effects of the 1973 oil crisis were devastating for the global economy. Oil prices quadrupled, leading to skyrocketing energy costs and widespread inflation. The so-called stagflation phenomenon, a combination of stagnant economic growth, high unemployment, and high inflation, was most pronounced in the United States and other advanced economies. Central banks struggled to manage the crisis, as traditional monetary policies, such as increasing interest rates, could not simultaneously address high inflation and unemployment. The oil shock had long-term consequences for energy policy and global geopolitics. In response, countries sought to reduce their dependence on oil, and new energy policies emerged, including a push for alternative energy sources. The crisis also led to the formation of strategic oil reserves and a reevaluation of global energy security. Economies began to focus on more diversified energy sources, which shaped energy policy for decades. The oil crisis also marked the decline of the post-World War II economic boom. It forced many developed nations to confront the limitations of their energy consumption and the vulnerabilities of their economies to global supply disruptions. 3. The Asian financial crisis, 1997 to 1998. The Asian financial crisis of 1997 to 1998 was one of the most significant financial disasters to impact the global economy in recent history. It began in Thailand with the collapse of the Thai baht after the government decided to float the currency, a move that was precipitated by a massive buildup of foreign debt and speculative investment in the real estate sector. The currency devaluation spread to neighboring countries, including Indonesia, South Korea, Malaysia, and the Philippines. The causes of the crisis were rooted in the rapid expansion of credit in the region, along with an over-reliance on foreign investment and high levels of short-term debt. Many Southeast Asian countries had pegged their currencies to the US dollar, making them vulnerable to external shocks. In addition, weak banking systems and a lack of financial transparency exacerbated the situation. The immediate effects of the crisis were severe, with many countries in the region experiencing economic contractions, currency devaluations, and widespread social unrest. Thailand, Indonesia, and South Korea saw their economies shrink by as much as 10% in some years. The International Monetary Fund, IMF, stepped in with bailout packages for several countries, but the stringent austerity measures tied to these loans led to social and political turmoil. The Asian financial crisis marked a turning point for emerging markets and led to a reevaluation of global financial systems. It prompted reforms in banking regulations and corporate governance in the affected countries, and created a greater emphasis on economic transparency and oversight. Additionally, it signaled the growing interconnectedness of global financial markets and the potential risks associated with international capital flows. 4. The Global Financial Crisis, 2007 to 2009. The Global Financial Crisis, GFC, of 2007 to 2009 was triggered by the collapse of the housing bubble in the United States, which was fueled by risky lending practices, financial innovations like mortgage-backed securities, MBS, and excessive risk-taking by financial institutions. As housing prices plummeted, the value of MBS, along with other related financial products, collapsed, causing major financial institutions to fail or seek government bailouts. The GFC had a profound impact on the global economy. Stock markets crashed, major banks and corporations teetered on the brink of bankruptcy, and millions of people lost their homes and jobs. The resulting global recession led to widespread economic hardship, with unemployment rates climbing in both developed and developing countries. Governments around the world responded with aggressive fiscal and monetary policies, including large-scale stimulus packages and interest rate cuts. The U.S. Federal Reserve, for example, lowered interest rates to near-zero levels and initiated quantitative easing programs to inject liquidity into the financial system. The GFC also exposed serious weaknesses in global financial regulation and oversight. The collapse of Lehman Brothers, one of the largest investment banks in the world, underscored the dangers of excessive leverage and the lack of transparency in financial markets. In response, governments and international bodies implemented new regulatory frameworks, such as the Dodd-Frank Act in the U.S. and Basel II internationally, aimed at reducing systemic risks in the financial system. One key lesson from the GFC was the interconnectedness of global financial markets. The crisis demonstrated that what happens in one part of the world, especially in major economies like the U.S., can have far-reaching consequences. The GFC also highlighted the importance of financial institutions being able to withstand shocks and the role of government intervention in stabilizing economies during crises. The global economic crises analyzed here: the Great Depression, the 1973 oil crisis, the Asian financial crisis, and the global financial crisis, demonstrate that while each crisis is unique in its causes, the consequences are often similar. They result in widespread economic disruption, social upheaval, and a reevaluation of global financial systems. In response, governments and international organizations have increasingly adopted measures to protect their economies and prevent future disasters. While it is impossible to predict the next crisis, the historical patterns and lessons learned from these events offer valuable insights. Economic policies that emphasize regulation, transparency, and diversified risk management are key to mitigating the risks of future crises. In an increasingly interconnected world, Global cooperation and foresight will be essential in navigating the complex challenges of the future. As we move forward, it is clear that economic crises are an inherent part of the global financial landscape. However, the resilience demonstrated by economies throughout history offers hope that with the right policies and international cooperation, future crises can be better managed and, ultimately, overcome. Thanks for watching. If you enjoyed this video, please like, subscribe, and hit the bell icon so you never miss an update. Drop a comment with your thoughts, and I'll see you in the next one.